Hi everyone, welcome back to my channel. Have you ever opened a bank account and then realized you had no idea what to actually do with it? Or heard words like FD, interest rate, or nominee and just nodded like you understand? You are not alone. Most people do not learn how banking really works, not in schools and even from their parents. And that's a problem. Because understanding basic banking is not just for finance nerds, it's the foundation of managing your money. The difference between a saving account and a current account, that's not just a random detail, it decides how your money behaves every single day. In this video, I will break down everything you need to know to take control of your money, how to use different bank account, what's the real deal with fixed and recurring deposits, the one difference between simple and compound interest that can literally change your future, how inflation silently eats your savings, and why setting a nominee might be the smartest thing you do this year. Don't worry, no jargon, no fluff, just real talk and clear examples. If you have a bank account or plan to get one, this is for you. Let's start with something simple but super important, the difference between a saving account and a current account. A saving account is like a safe locker for your money. It's designed to help you save, earn interest, and grow your balance over time. You get limited monthly transactions, and in return, the bank gives you a little interest, like a mini reward for not touching your money too much. A current account, on the other hand, is built for people who need to move money frequently, like business owners, shopkeepers, or freelancers. It usually does not offer interest, but you can deposit or withdraw as often as you like without limits. So, if you are a student, a salaried employee, or someone looking to slowly build savings, a saving account is the way to go. But if you are running a business or making regular payments, a current account gives you the freedom you need. Think of it like this: saving account is equal to earning slowly, spending carefully. On the other hand, current account is equal to spending freely, earning elsewhere. Choosing the right account is not about status, it's about how your money flows in real life. Make the smart choice that fits your lifestyle. Let's talk about FDs and RDs, are in full form, fixed deposits and recurring deposits. These are two powerful tools bank offers to help you grow your savings, but they work very differently. A fixed deposit is like planting a money tree. You put in a lump sum, say 10,000 for a fixed period, like 1 or 3 years. You do not touch it. In return, the bank gives you a higher interest rate than a regular saving account. The longer you leave it, the more it grows. When it matures, you get your money back plus all the interest. Now, one RD or recurring deposit is more like watering a plant regularly. Instead of putting in a lump sum, you deposit a fixed amount every month, like 1000 every month for 2 years, and just like the FD, it earns interest and grows over time. So, what's the difference? FD is one time deposit, long term wait. RD is monthly habit, gradually build up. FDs are great when you have extra money lying around, maybe from a bonus, gift, or tax refund, and want to lock it away safely. RDs are perfect if you want to build discipline, develop a saving habit, and commit to small, regular investment. Also, both FD and RD are low risk and ideal for beginner. But here's the tip: always compare the interest rate, tenure options, and penalty rules before starting either. And one more thing, don't break your FD early unless it's urgent. Most banks charge a penalty and you lose some interest. Some RDs also come with penalties if you skip payments. In summary, FD is equal to one time save, higher return. RD is equal to monthly save, habit builder. Both are smart choice. Pick the one that match your saving style and goal. Alright, let's break down a word you have probably heard 1,000 times: interest. When you keep money in the bank uses that money to give out loan. In return, then pay you some extra cash as a thank you. That's interest. But not all interest is created equal. There are two main types: simple interest and compound interest. Simple interest is well simple. You earn interest on your original amount only. So if you deposit 10,000 at 5% per year, you get 500 every year. That's it. It does not grow faster over time and it does not reward you for staying invested longer. But compound interest is where the magic happens. Here you earn interest on your original amount and the interest you have already earned. So in year 1 you get 500, in year 2 you earn interest not just on 10,000 but on 10,500 and by year 3 it's even more. It's like a snowball rolling down a hill. At first it's slow and small, but as it rolls, it picks up more snow and grows faster. Let's say you invest 10,000 for 10 years. With simple interest at 5%, you will end up with 15,000. With compound interest at 5%, you will have around 16,470. That 1,470 extra just by letting time do its thing. And here's the real kicker, if you leave it for 20 or 30 years, that gaps become huge. Compound interest rewards patience, not effort. Small recap, simple interest is equal to flat growth, compound interest is equal to snowball growth. So next time you open an FD or RD or even invest in mutual fund, ask, is it compound interest? Because that's how your money works hardest for you. Let's talk about something that quietly drain your money every single year. Inflation. Inflation means that the value of money goes down over time. In simple words, what you can buy for 100 today might cost 110 next year. Same item, more money. So if your money is just sitting in your bank, not growing, it's actually losing power. Here's an example. Imagine you kept 10,000 under your mattress. After 1 year, it's still 10,000, right? But if inflation was 6%, that same 10,000 now buys only 9,400 worth of stuff compared to last year. You did not spend it, but it's still worthless. This is why just saving is not enough. Your money needs to grow faster than inflation. That's why earning interest, especially compound interest, is so important. Inflation is the reason 50 rupees used to buy groceries for a week in the 90s and now it barely buys snacks. So the smart move, always keep your savings in place that beat inflation like FDs, RDs or smart investment. Small recap, inflation is equal to price rise and money shrink. Fight it by growing your money, not just saving it. Here's a question no one asks until it's too late. If something happens to you, who gets your money? That's where the nominee comes in. A nominee is the person you authorize to receive your money, your bank balance, FD, RD, if you pass away. It does not mean they automatically become the owner of the money forever, but it gives them the right to claim and access it quickly. Without a nominee, your family may have to go through legal headaches, paperwork, and long delays just to assess your savings. And that can be really stressful in already difficult time. Setting a nominee is free, takes just 2 minutes and can be done online or at your bank branch. You can even change it anytime. Quick tip, every account that is savings, FDs or RDs should have a nominee. Don't skip it, it's a small step that makes a huge difference. Now that you know the basics, let's make your banking smarter with a few practical tips anyone can follow. Number 1, always set up auto debit for savings. If you wait to save what's left, you will save nothing. But if you automate a small amount every month, it builds up without you even noticing. Number 2, don't keep too much in your saving account. It's safe, but the interest is low. Move extra money to an FD, RD or a liquid fund where it earns more. Number 3, check your bank statement every single month. Banks sometimes deduct charges quietly. Spotting mistakes early saves you money and teaches you where your money goes. Number 4, use UPI and net banking but protect your password. Digital banking is super convenient but never share your PIN, OTP or login credentials. Ever. Number 5, choose banks with low or no maintenance charges. Hidden fees eat your savings. Compare bank features not just brand name. Bonus tip, link your email and phone number to your bank so you get alert instantly if anything happen. Small recap, small action today is equal to big money safety tomorrow. You do not need to be rich to manage money smartly. Just a little awareness goes a long way. Alright, let's bring it all together. You now understand the difference between a savings and a current account, how FDs and RDs work, why compound interest is your money's best friend, how inflation quietly steals value, and why adding a nominee is non negotiable. Banking is not just about keeping money, it's about managing it wisely. And the good news, you do not need to be an expert to get started. If you apply even one tip from today's video, you are already ahead of most people. So here's your next step. Check your account type, set or update your nominee, automate your savings. And if this video helped you, imagine how many others it can help too. Give it a like, drop your questions or experience in the comment, and hit that subscribe button for more real world money tips made simple. Because smart money choice start with understanding, not income. Thanks for watching and see you again.